Hello everyone, in this module we study chapter 7, risk and return. The learning objectives include define risk, risk aversion, and risk return trade-off, measure risk, identify different types of risk, explain methods of risk reduction, describe how firms compensate for risk. Discuss the KPI. Expected return. Expected return is the mean of the probability distribution of possible returns. Future returns are not known with certainty. To calculate expected return, compute the weighted average of possible returns. Expected return calculation. For example, you are evaluating Zoomwort Corporation's common stock. You estimate the following returns given different state of the economy. So you can use the probability times the return for each state of economy and sum them together. That's the expected rate of return on the stock. Risk is the potential for unexpected events to occur. If two financial alternatives are similar except for their degree of risk, most people will choose the less risky alternative because they are risk averse. For example, they don't like risk. Risk-averse investor will require higher expected rate of return as compensation for taking on higher levels of risk. Measurement of investment risk. Standard deviation measures the dispersion of returns. It is the square root of the variance. Risk and rate of return. Risk of a company's stock can be separated into two parts. The first part is firm-specific risk, the risk due to factors within the firm. The second part is market-related risk, the risk due to overall market conditions. Risk and diversification. If an investor holds enough stock in portfolio, about 20 stocks, firm-specific or diversifiable risk is virtually eliminated. Market risk and rate of return. Market risk is the risk of the overall market. So to measure, we need to compare individual stock returns to the overall market returns. A proxy for the market is usually used. An index of stocks such as the SP 500. Regress individual stock returns on market index. We can have a best fit regression line. The market risk is measured by beta. So beta is the slope of the regression or characteristic line. The capital asset pricing model. The KPI measures the required rate of return for investment given the degree of market risk measured by beta. So we can have a security market line equals to the following equation. Suppose that the required rate of return on the market is 12% and the risk-free rate is 5%. So we can have the following equation. And suppose that the required return on the market is 12% and the risk-free rate is 5%. If beta is 1.2, you can have the required return of the stock 13.4%.